大家好，讀你聽嘅時間，今日繼續讀 Michael Lewis 嘅 Liar's Poker， 讀到第6節啦。咁上一回呢就講緊 Salomon Brothers 入面兩大部門啦，呢個 Mortgage Department， 仲有傳統嘅 Bond Department 啦，仲有一啲比較被忽視嘅 Equity Department 啦，佢哋之間嘅角力啦，佢哋之間嘅分別啦，佢哋揾嘅錢嘅差距啦，呢個 Ranieri 所帶起嘅呢一個部門，佢所帶嚟嘅財富啦，佢嘅思維啦，咁亦都影響咗美國華爾街嘅經濟啦，影響咗華爾街嘅投資市場嘅方向走向。好啦，我哋呢一節繼續睇下80年代美國華爾街嘅狀況係點先。Chapter 6 The Fat Man and Their Marvelous Money Machine 1981 to 1986 Lights began to flash on the mortgage trading desk in October 1981, and at first no one knew why. On the other end of the telephones were nervous savings and loan presidents from across America wanting to speak to a Salomon mortgage trader.They were desperate to sell their loans. Every home mortgage in America, $1 trillion worth of debt, seemed to be for sale. There were 1,000 sellers and no buyers. Correction, one buyer, Louis Ranieri and his traders. The force of the imbalance between supply and demand was stunning. It was as if a fire hydrant burst directly upon a group of thirsty street urchins. $1 trillion came barreling through the telephone lines.And all the traders had to do was open their mouths and swallow as much as they could. What was going on? From the moment the Federal Reserve lifted interest rates in October 1979, thrifts hemorrhaged money. The entire structure of home lending was on the verge of collapse. There was a time when it seemed that if nothing were done, all thrifts would go bankrupt. So on September 30th, 1981, Congress passed a nifty tax break.For its beloved thrift industry. It provided massive relief for thrifts. To take advantage of it, however, the thrifts had to sell their mortgage loans. They did, and it led to hundreds of billions of dollars in turnover on Wall Street. Wall Street hadn't suggested the tax breaks, and indeed, Ranieri's traders hadn't known about the legislation until after it happened. Still, it amounted to a massive subsidy to Wall Street from Congress. Long live motherhood and home ownership.The United States Congress had just rescued Ranieri and Co. The only fully staffed mortgage department on Wall Street was no longer awkward and expensive. It was a thriving monopoly. It was all a great mistake. The market wasn't exploding because of the megatrends that Bob Dow had listed in his memo to Goodfriend, although those later became factors. The market took off because of a simple tax break. It was as if Steve Jobs had bought office space.Built an assembly line, hired 200,000 salesmen, and written brochures before he had anything to sell. Then someone else creates his personal computer, and seeing this, Jobs leaps into action, calling his previously useless infrastructure Apple Computer. Bond traders tend to treat each day of trading as if it were their last. This short-term outlook enables them to exploit the weakness of their customers without worrying about the long-term effects on customer relations.They get away with whatever they can. A desperate seller is in a weak position. He's less concerned about how much he is paid than when he is paid. Thrift presidents were desperate. They arrived at the Salomon Brothers mortgage trading desk hat in hand. If they were going to be so obvious about their weakness, they might as well have written a check to Salomon Brothers. The situation was aggravated by the ignorance of the thrifts.The 363 Club members had not been stress tested for the bond market. They didn't know how to play liar's poker. They didn't know the mentality of the people they were up against. They didn't know the value of what they were selling. In some cases, they didn't even know the terms of their own loans. The only thing the thrift managers knew was how much they wanted to sell. The truly incredible thing about them, noted by all the Salomon traders, was that no matter how roughly they were treated, they kept coming back for more.They were like ducks I once saw on a corporate hunt that were trained to fly repeatedly over the same field of hunters until shot dead. You didn't have to be Charles Darwin to see that this breed was doomed. Trader Tom DiNapoli fondly remembers a call from one thrift president. He wanted to sell $100 million worth of his 30-year loans and buy $100 million of some other loans with the cash from the sale. I told him I'd bid his loans at 75 and offer him the others at 85. The thrift president scratched his head at the numbers. He was selling loans nearly identical to those he was buying, but the difference in yield would leave him out of pocket an unheard of $10 million. Or, to put it another way, the thrift was being asked to pay a transaction fee of $10 million to Salomon Brothers. That doesn't sound like a very good trade for me, he said. The Napoli was ready for that one. It isn't, from an economic point of view, he said, but look at it this way. If you don't do it, you're out of a job. A fellow trader talking to another thrift president on another line overheard the Napoli and cracked up. It was the funniest thing he had heard all day. He could picture the man on the other end of the phone, just oozing desperation. October 1981 was the most irresponsible period in the history of the capital markets, says Larry Fink, a partner with Stephen Schwarzman, Peter Peterson, and David Stockman in the Blackstone Group. In October 1981, Fink was head of the small mortgage trading department at First Boston, which would soon grow large and become Louis Ranieri's major competitor. The thrifts that did the best did nothing. The ones that did the big trades got raped. Perhaps. However, like all trades in the bond market, these were negotiable transactions between consenting adults, and the sole rule of engagement was buyer beware. Had this been a boxing match, it would have been cancelled to prevent the weaker fighter from being killed. But it wasn't. In any case, the abuse could have been even worse. Ranieri had a sense of mercy and, where he could, stepped in to redress the balance of power between the thrift presidents and his traders. Mortgage trader Andy Stone recalls having bought $70 million of mortgage bonds at a price of $80. At Stone's insistence, a bond salesman in California sold them immediately to Ben Franklin Savings and Loan for a price of $83. In minutes, Stone had made $2.1 million. After the customary slapping of palms and the praising of the salesman over the firm loudspeaker, Stone informed Ranieri. Now, $2.1 million was a good day's work. Stone had been a trader for just 8 months, and he was eager to show the boss how well he was doing. The boss wasn't pleased. Louis said, "If you weren't young, I'd fire you right now. Call the customer and tell him you're the who ripped him off. Tell him you bought the bonds at 80, and the price is therefore not 83, but 80.25, says Stone. Imagine how it feels to call up customer and say, "Hi, I'm the who ripped you off." It wasn't just the dummies who queued to trade with Salomon Brothers. Even knowledgeable thrift presidents felt they faced a choice between rape and slow suicide. To do nothing spelled bankruptcy for many. Paying out 14% on deposits while taking in 5% on old home mortgage loans was a poor way to live, but this is precisely the position thrifts were in. By late 1982, the thrifts were attempting to grow their way out of catastrophe. By that time, short-term interest rates had fallen below long-term interest rates. The thrift could make new mortgage loans at 14% while taking in money at 12%. Many thrifts layered $1 billion of brand new loans on top of their existing disastrous $100 million of old loss-making loans in the hope that the new would offset the old. Each new purchase of mortgage bonds was like the last act of a desperate man. The strategy was wildly irresponsible, for the fundamental problem hadn't been remedied. The hypergrowth only meant that the next thrift prices would be larger, but the thrift managers were not thinking that far in advance. They were simply trying to keep the door to the shop open. That explains why thrifts continued to buy mortgage bonds even as they sold their loans. The tax and accounting breaks, designed to rescue the savings and loan industry, seemed in the end to be tailor-made for Louis Ranieri's mortgage department. It rained gold on Salomon Brothers mortgage traders, or at least that is how it appeared to the rest of envious Wall Street. Ranieri allowed his boys to assume a carefree buy now, very later attitude in the midst of upheaval in the thrift industry, and the Salomon traders found themselves in a weird new role. They were no longer trading mortgage bonds, but the raw material for mortgage bonds, home loans. Salomon Brothers was all of a sudden playing the role of a thrift. Nothing, not Ginnie Mae, not the Bank of America, stood between Wall Street investment banker and homeowner. Salomon was exposed to the homeowner's ability to repay. A cautious man would have inspected the properties he was lending against, for nothing but property underpinned the loans. But if you plan to run with this new market, you did not have time to check every last property in a package of loans. Buying whole loans was an act of faith, like eating bologna. Leaps of faith were Ranieri's specialty. A quick mental calculation told him that whatever the cost of buying bad loans, it couldn't possibly match the profits he would make by trading the things. He turned out to be right. Once he ended up with loans that had been made to a string of Baptist churches in Texas, but generally the loans were for housing, just as the thrift managers who sold them had claimed. However, as I've said, the notion of trusting the thrifts gave Salomon's top brass the willies. As Ranieri recalls, the executive committee said I couldn't trade whole loans, so I just went out and did it anyway. Everyone insisted I shouldn't have done it. They told me I was going to go to jail. But whole loans were 99.9% of the entire mortgage market. How could you not trade whole loans? How indeed. We bought them, says Tom Kendall, and then found out you had to have an EGLE before you buy them. An EGLE was Federal Housing Administration approval to trade in whole loans. So then we went and got the EGLE. Ranieri & Co. intended to transform the whole loans into bonds as soon as possible by taking them for stamping to the U.S. government. Then they could sell the bonds to Salomon's institutional investors as, in effect, U.S. government bonds. For that purpose, partly as a result of Ranieri's persistent lobbying, 2 new facilities had sprung up in the federal government alongside Ginnie Mae. They guaranteed the mortgages that did not qualify for the Ginnie Mae stamp. The Federal Home Loan Mortgage Corporation and the Federal National Mortgage Association between them. By giving the guarantees, were able to transform most home mortgages into government-backed bonds. The thrifts paid a fee to have their mortgages guaranteed. The shakier the loans, the larger the fee a thrift had to pay to get its mortgages stamped by one of the agencies. Once they were stamped, however, nobody cared about the quality of the loans. Defaulting homeowners became the government's problem. The principle underlying the programs was that these agencies could better assess and charge for credit quality than individual investors. The wonderfully spontaneous mortgage department was the place to be if your philosophy of life was ready, fire, aim. The payoff to the swashbuckling traders by the standards of the time was shockingly large. In 1982, coming off 2.5 lean years, Louis Ranieri's mortgage department made $150 million. In 1984, a mortgage trader named Stephen Baum shattered a Salomon Brothers record by making $100 million in a single year trading whole loans. Although there are no official numbers, it was widely accepted at Salomon that Ranieri's traders made $200 million in 1983, $175 million in 1984, and $275 million in 1985. Louis Ranieri was the right man at the right place at the right time. Louis was willing to take positions in things he didn't fully understand. He had a trader's instinct that he trusted. That was important, says one of his senior traders. The attitude at Salomon was always, if you believe in it, go with it, but if it doesn't work, you're And Louis responded to this. At other places, management says, well, gee, fellas, do we really want to bet the ranch on this deal? Louis was not only willing to bet the ranch, he was willing to hire people and let them bet the ranch too. His attitude was, sure, what the it's only a ranch. In other shops, he'd have to write a 200-page memo for a committee that wanted to be sure that what he was doing was safe. He would have had to prove he knew what he was doing. He could never have done that. He knew what he was doing, but he could never have proved it. Had Louis been assigned to look at the mortgage market at other firms, he wouldn't have gone anywhere. The Salomon trading floor was unique. It had minimal supervision, minimal controls, and no position limits. A trader could buy or sell as many bonds as he thought appropriate without asking. The trading floor was, in other words, a CEO's nightmare. If Salomon's trading floor was a business school case study, says mortgage trader Wolf Naduman, the guy pretending to be the CEO would say, that is shocking, but you know what? He'd be wrong. Sometimes you lose some dough, but sometimes you make a fortune. Salomon was right. Salomon's loose management style had its downside. Salomon Brothers was the only major firm on Wall Street in the early 1980s with no system for allocating costs. As unbelievable as it seems, no measure was taken of the bottom line. People were judged by the sum total of the revenues on their trading books, irrespective of what those cost to generate. When the firm was a partnership and managers had their own money in the till, loose control sufficed. Now, however, the money didn't belong to them but the shareholders. and what worked for a partnership proved disastrous in a publicly owned corporation. Instead of focusing on profits, trading managers focused on revenues. They were rewarded for indiscriminate growth. Gross revenues meant raw power. Ranieri had finally been made partner in 1978. His influence waned with his revenues until the end of 1981, but when the mortgage market exploded, he began a rapid rise to the top of Salomon Brothers. In 1983, with his department generating 40% of the firm's revenues, while no other department generated more than 10%, he was placed on the Salomon Brothers Executive Committee. He expanded by hiring more traders and moving into real estate mortgages. In December 1985, John Goodfriend told a reporter, "Liu is very definitely on the short list of potential future chairmen." Ranieri expanded by purchasing a mortgage banker who made loans directly to home buyers and supplied Ranieri with the raw material for mortgage bonds. In 1986, Ranieri was named to the office of the chairman directly beneath Goodfriend. In that year, Ranieri expanded overseas, creating the Mortgage Corporation in London to reshape the British mortgage market in the image of America's. Joining him in the office of the chairman was one representative each of the government and corporate bond trading desks, Tom Strauss and Bill Voot. Both were also on a short list of potential future chairmen. Both were expanding their department as well, though not as fast as Ranieri. By mid-1987, though it has proved impossible to confirm the assertion, a Salomon managing director claimed that 40% of the 7,000-odd Salomon employees reported, in one way or another, to Ranieri. With trading revenues came glory and advancement at every level of the company. The numbers on a neighbor's trading book became known within Salomon Brothers in the same manner as the size of a neighbor's bonus. Though trainees were the last to hear anything, word eventually reached them of the opportunity created by the massive change in the capital markets over which Salomon presided. All you had to do was sit in the classroom, find out how many mortgages there were in the country, figure out what could happen if they securitized, say 10% of them, and you realize this was going to be big, says former Salomon trader Mac Fried, a member of the Salomon class of 1982. By 1984, Salomon Brothers could plausibly assert to a U.S. congressional subcommittee that the nation would require $4 trillion in new housing finance before 1994. Ranieri, the conquering hero, the Salomon legend, the incarnation of the concept of success, appeared before the training class to describe how he had just flown in from California and how he had looked down from his airplane and seen all those little houses and how all those little houses were mortgaged and how all those mortgages would eventually make their way onto the trading floor of Salomon Brothers. By 1984, the mortgage desk would be the place to work in the eyes of young MBAs emerging from the Salomon Brothers training program. People wanted to trade mortgages, to be Salomon Brothers mortgage traders, to be a part of a money machine that by this time was earning more than half of the firm's revenues. Salomon Brothers mortgage traders rode roughshod over both the largest capital market in the world and their own firm, which was far and away the most profitable on Wall Street. They felt lucky. It was an accepted fact, says the mortgage trader, that mortgage traders had iron. It was an accepted fact that as a mortgage trader, you didn't make a lot of money in your market, you made all the money in your market. It was an accepted fact that you didn't do some of the trades in your market, you didn't do most of the trades in your market, you did all of the trades in your market. To do all the trades in your market, you had to have buyers as well as sellers. And these, in October 1981, were thin on the ground. Ranieri, along with the guru of junk bonds, Mike Milken and Drexel Burnham, became one of the great bond missionaries of the 1980s, crisscrossing the country, trying to persuade institutional investors to buy mortgage securities. Ranieri bumped into Milken. They visited the same accounts on the same day. My product took off first, says Ranieri. Investors started to buy the gospel according to Ranieri. The gospel according to Ranieri was, in simple terms, that mortgages were so cheap your teeth hurt. Ranieri's initial pitch focused on how much higher the yield on mortgage bonds was than the yield on corporate and government bonds of similar credit quality. Most mortgage bonds were accorded the highest rating, AAA, by two major rating agencies, Moody's and Standard & Poor's. Most mortgage bonds were backed by the United States government, either explicitly, as in the case of Ginnie Mae bonds, or implicitly, as in the case of Freddie Mac and Fannie Mae. No one thought the U.S. government would default. The investors nevertheless wanted no truck with Ranieri or Ranieri's growing army of salesmen. In spite of the upheaval in the mortgage market, the initial objection expressed by Bill Simon and Ginnie Mae remained valid. You couldn't predict the life of a mortgage bond. It wasn't that prepayments were bad in themselves. It was that you couldn't predict when they would arrive. And if you didn't know when the cash would come back to you, you couldn't calculate the yield. All you could surmise was that the bond would tend to maintain its stated maturity as rates rose and homeowners ceased to prepay, and would shorten as rates fell and homeowners refinanced. This was bad, though the conditions of supply had changed overnight in October 1981. The conditions of demand for mortgage securities had not. Mortgages, indeed, were cheap. They were plentiful, yet no one wanted to buy them. Worse, in several states, mortgage securities were still illegal investments, a condition Ranieri didn't fully accept. In a meeting, he screamed at a lawyer whom he had never met. I don't want to hear what lawyers say. I want to do what I want to do. He sought a federal preemption of state laws, and he began to look for a way to make mortgages resemble other bonds, a way to give mortgage securities a definite maturity. Ultimately, he wanted to change the way Americans borrowed money to buy their homes. I ought at least be allowed the right, he said, to go to the consumer and say, here are two identical mortgages, one at 13% and one at 12.5%. You can have either one you want. You can refinance the one at 13% anytime you want for whatever reason you want. The one at 12.5%, if you move or die or trade up, has no penalty. But if you just want to refinance it for savings and debt service, you pay me. Congress gave him permission to sell his mortgage securities in every state, but to his more radical proposition, it said no. The homeowner kept his right to prepay his mortgage at any time, and Ranieri was forced to find another way to persuade institutional investors to buy his God-forsaken mortgage securities. So he did. Louis Ranieri could sell ice to an Eskimo, says Scott Britman, who accompanied him on many of the sales calls. He was so good with customers you couldn't keep him on the trading desk, says Bob Dahl, who was coming to the end of his day at Salomon. Says Ranieri, I stopped trying to argue with customers about prepayments and finally started talking price. At what price were they attractive? There had to be some price where the customers would buy. 100 basis points over treasuries. 200 basis points? I mean, these things were 350 basis points off the curve. All American homeowners had a feel for the value of the right to repay their mortgage at any time. They knew if they borrowed money when interest rates were high, they could pay it back once rates fell and re-borrow at the lower rates. They liked having that option. Presumably, they would be willing to pay for the option. But no one, even on Wall Street, could put a price on the homeowner's option. Being a trader, Ranieri figured and argued that since no one was buying mortgages and everyone was selling them, they must be cheap. More exactly, he claimed that the rate of interest paid by a mortgage bond over and above the government, or risk-free, rate more than compensated the mortgage bondholder for the option he was granting to the homeowner. Ranieri cast himself in an odd role for a Wall Street salesman. He personified mortgage bonds. When people didn't buy them, he appeared wounded. It was as if Ranieri himself were being sold short. He told the United States banker in 1985, those of us in housing felt the market was charging us more of a premium for the prepayment risk than the real value. Think about the way that sentence is put. Who are those of us in housing? Ranieri himself wasn't charged a premium. It was the homeowner who was charged. Louis Ranieri, formerly of the Salomon Brothers mailroom and utility bond trading desk, had become the champion of the American homeowner. It was a far more appealing persona than that of the slick, profiteering Wall Street trader. Louis had the spiel about building homes for America, says Bob Dahl. When we'd come out of those meetings, I'd say, come on, you don't think anyone believes that, do you? But that was what made Ranieri so convincing. He believed that, Ranieri was perhaps the first populist in the history of Wall Street. The great Louisiana politician Huey P. Long campaigned on the slogan, a chicken in every pot. Louis Ranieri moved bonds off his trading books with the slogan, a mortgage on every home. It helped that Ranieri looked the part of the common man. It was a great act, admits his protege Kronthal. To work, Ranieri wore black Johnny Unitas-style ankle-high boots and 6-inch wide neckties. Every Friday he arrived on the trading floor in a tan polyester jacket and black chinos. He owned exactly 4 suits, all polyester. As he grew wealthy, earning between $2 and $5 million in each year of the golden years between 1982 and 1986, he continued to own 4 suits. Jeffrey Kronthal recalls, "We used to kid him that he stood in line at the mail shop in Brooklyn to get his suits. They used to sell you a suit with a trip to Florida, a bottle of champagne, and food stamps, all for $99. With his money, Ranieri bought 5 power boats. Then I had more boats than suits," he says. Other than that, he lived modestly, without flashy cars or new homes. The clothes made the man, and everyone noticed the clothes. The suit said, "I haven't forgotten that I came from the back office, and don't you forget it either." They also said, "I'm Louis, not some schmuck-rich investment banker. There's no artifice here. You can trust me, and I'll take care of you." Under the weight of Ranieri and his traders, investor mistrust eroded, and slowly investors began to buy mortgages. Andy Carter of Jennison in Boston was the first to buy the gospel according to Ranieri, says Ranieri. More important, Ranieri was the guru of the thrift industry. Dozens of the largest thrifts in America wouldn't budge without first seeking Ranieri's advice. They trusted him. He looked like them, dressed like them, and sounded like them. As a result, thrift managers who could have bought Mike Milken's junk bonds when they sold their loans stayed heavily concentrated in mortgage bonds. Between 1977 and 1986, the holdings of mortgage bonds by American savings and loans grew from $12.6 billion to $150 billion. But the number dramatically understates the importance of the thrifts to the fortunes of Ranieri & Co. Ranieri's sales force persuaded the thrift managers to trade their bonds actively. A good salesman could transform a shy, nervous thrift president into a maniacal gambler. Formerly sleepy thrifts became some of the biggest swingers in the bond markets. Despite their dwindling numbers, the thrifts as a group nearly doubled in asset size from $650 billion to $1.2 trillion between 1981 and 1986. Salmon trader Mac Fried recalls a visit he paid on a large California thrift manager who had been overexposed to Wall Street influence. Fried actually tried to convince the thrift manager to calm down, to take fewer outright gambles on the market, to reduce the size of his positions, and instead hedge his bets in the bond market. "You know what he told me," says Fried. "He said hedging was for sissies." Various Salmon mortgage traders estimate that between 50 and 19% of their profits derive from simply taking the other side of thrift trades. Why, you might wonder, did thrift presidents tolerate Salmon's huge profit margins? Well, for a start, they didn't know any better. Salmon's margins were invincible. And since there was no competition on Wall Street, there was no one to inform them that they were making Salmon Brothers rich. What was happening, and is still happening, is that the guy who sponsored the float in the town parade, the 363 Club member and golfing man, had become America's biggest bond trader. He was also America's worst bond trader. He was the market's fool. Despite their frenetic growth, savings and loans, as Bob Dow had predicted, could not absorb the volume of home mortgages created in the early 1980s. Being a mortgage trader at Salmon often meant being a mortgage buyer than a mortgage seller. Steve Baum was running a $2 billion thrift, says one of his former colleagues. Like a thrift, Baum found himself sitting on loans for long periods. This completed the curious reversal in roles that occurred in the early 1980s, when thrifts became traders and traders' thrifts. Michael Matara nicknamed Baum "I buy Baum" since he seemed never to sell anything. That, it turned out, was a stroke of luck. The bond market was on the verge of a record rally, as Henry Kaufman recalled in Institutional Investor. We reached about 21.5% on the prime rate, and we reached 17.5% on the bill rate in the early 1980s. The peak of long-term interest rates was reached in October 1981, when long governments hit about 15.25%. I only sensed that in the third quarter of 1982 that the economy was not about to get back on its feet very quickly, and so finally, in August 82, I became bullish. And of course, that day when I turned bullish, the stock market had the biggest gain in history. On that day, the bonds rallied dramatically. We were going into an executive committee meeting for the firm at the Waldorf. I had written the night before a 2-pager indicating that I thought yields would go down quite sharply and my rationale for it. And I had given it to my driver to deliver to my secretary, so she could type it up and put it into our machine. on our screens to be shown to our traders and salespeople at the same time, around 8:45 or 9 in the morning before the market opened. I then went to the Waldorf where we had 8 people from the executive committee. I got a call from my secretary asking me to explain something that I had written because she was typing it out. I had written in longhand, and I think it was John Goodfriend who said, "What are you on the phone for?" And I said, "I just dictated a memo." Somebody said, "What about?" And I said, "Well, I've just changed my view on the market." And they said, "You've changed your view on the market?" Well, by that time, it was going on the screen, and then the markets went wild. Ranieri & Co. had been forced by the glut into owning billions of dollars of mortgage bonds because of conditions of supply and demand in the market. They had no choice but to bet on the bond market going up. They watched with glee, therefore, the biggest bond market rally in the history of Wall Street. They had Kaufman to thank at first. When Henry said it was going up, it went up. But then the Federal Reserve allowed interest rates to fall. Policy in Washington, as anticipated by Kaufman, had taken a second fortune turn for Ranieri and his band of traders. We are talking off to the races. Bond futures up 16 points in a week, unreal, recalls Wolf Naduman. The mortgage department was the envy of the firm. The hundreds of millions of dollars of trading profits realized by the handful of mortgage traders derived in large part from a combination of the market going up and the blessed ignorance of America's savings and loans. Yet there were other, more intriguing ways Ranieri made money. Ranieri's trader found that their counterparts at other firms could be easily duped. Solomon's was the only mortgage trading desk without direct phone lines to other Wall Street investment banks, preferring instead to work through intermediaries called interbroker dealers. "We dominated the street," says Andy Stone. "You'd buy bonds at 12, even when they were trading at 10, to control the flow. The research department would then produce a piece saying the bonds you had just bought at 12 were really worth 20. Or we'd buy 6 million more of the things at 12. The rest of the street would see them trading up the screens and figure, hey, retail buying, better buy too, and take us out of our position." Translation: Solomon could dictate the rules of the mortgage bond trading game as it went along. As time passed, Ranieri grew less involved with the day-to-day decisions made on the trading desk. Louis was a brilliant big-picture guy, says Annie Stone. He'd say that mortgage bonds were going to do better than treasury bonds over the next 2 weeks, and he was right 95% of the time. And if he wasn't, he could always call up 19 thrifts and persuade them to buy our position in mortgages. Ranieri was not, however, a brilliant detail guy, and the traders were beginning to delve into the minutiae of the mortgage market. The nature of the trader changed, says longtime mortgage bond salesman Samuel Sachs. They wheeled in the rocket scientists, who started to carve up mortgage securities into itty-bitty pieces. The market became more than the 5 things that Louis could hold in his brain at any one time. The young traders had MBA and PhDs. The first of the breed was Cronville, after whom came Hocht, Roth, Stone, Brittenham, Naduman, Baum, Kendall, and Howie Rubin. One trick the new young traders exploited was the tendency of borrowers to prepay their loans when they should not. In a nice example of Wall Street benefiting from confusion in Washington, Steve Roth and Scott Brittenham made tens of millions of dollars trading federal project loans, the loans made to the builders of house projects guaranteed by the federal government. By 1981, the federal government was running a deficit. It embarked on a program of asset sales. One group of assets it sold were loans that it had made to the developers of low-cost housing in the 1960s and 70s. The loans had been made at below market rates in the first place, as a form of subsidy. On the open market, because of their low coupons, they were worth far less than par. A typical loan was worth about 60 cents on the dollar. So, for example, a 30-year $100 million loan paying the lender 4% a year in interest might be worth $60 million. On the occasion of the government's sale of a loan, a tiny announcement appeared in the Wall Street Journal. It seemed only 2 people read it, Roth and Brittenham. Brittenham now says, "We dominated the market for years. When I came on board in 1981, we were really the only people buying them. The market was more of a game than most. The trick was to determine beforehand which of the government project loans was likely to prepay, for when it did, there was an enormous windfall to the owner of the loan, the lender. This arose because project loans traded below 100 cents on the dollar. When Roth and Brittingham bought loans at 60 cents on the dollar that prepaid immediately, they realized a fast 40 cents on the dollar profit. To win the money, you had to know how to identify situations in which the lender would get his money back prematurely. These, it turned out, were of two sorts. The first were the financially distressed. Where there was distress, there was always opportunity. It was great if you could find a government housing project that was about to default on its mortgage, says Brittingham. It was great because the government guaranteed the loan and, in the event of a default, paid off the loan in full. The windfall could be in the millions of dollars. The other kind of project likely to prepay its mortgage was the Cushy upmarket property. Brittingham recalls, you'd look for a nice property, not a slum, something like a nice pool, tennis court, microwave ovens. Then you found it, you say to yourself, that's a likely conversion. To convert, the occupants bought out the owner-developer, who would, in turn, repay the loan to the government. Once the government had received its money, it repaid Roth and Brittingham 100 cents on the dollar for a piece of paper they had just bought at 60. The thought of two young MBAs from Wall Street roaming the nation's housing projects in search of swimming pools and bankrupt tenants seems ridiculous until you have done it and made $10 million. The wonder is that the people in Washington who sold the loans did not do the same, but they didn't understand the value of the loans. Instead, they trusted the market to pay them the right price. The market, however, was inefficient. Even larger windfalls came from exploiting the inefficient behavior of the American homeowner. In deciding when to pay off his debts, the homeowner wasn't much craftier than the federal government. All across the country, citizens with 4%, 6%, and 8% home mortgages were irrationally insisting on paying down their home loans when the prevailing mortgage rate was 16%. Even in the age of leverage, there were still many people who simply didn't like the idea of being in hock. This created a situation identical to the federal project loan bonanza. The home loans underpinned mortgage bonds. The bonds were priced below their face value. The trick was to buy them below face value just before the homeowners repaid their loans. The mortgage trader, who could predict the behavior of the homeowners, made huge profits. Any prepayments were profits to the owner of the mortgage bond. He had bought the bond at 60. Now he was being paid off at 100. A young Salomon Brothers trader named Howie Rubin began to calculate the probability of homeowners prepaying their mortgages. He discovered that the probability varied according to where they lived, the length of time their loans had been outstanding, and the sizes of their loans. He used historical data collected by Lou Ranieri's research department. The researchers were meant to be used like scientific advisors in an arms talk. More often, however, they were treated like the water boys on a football team. But the best traders knew how to use the researchers well. The American homeowner became, to Rubin and the research department, a sort of laboratory rat. The researchers charted how previously sedentary homeowners jumped and started in response to the shock of changes in the rate of interest. Once a researcher was satisfied that one group of homeowners were more likely than another to behave irrationally and pay off low-interest rate mortgages, he would inform Rubin, who then bought their mortgages. The homeowners, of course, never knew that their behavior was so closely monitored by Wall Street. The money made in the early years was as easy as any money ever made at Salomon. Still, mortgages were acknowledged to be the most mathematically complex securities in the marketplace. Complexity arose entirely out of the option the homeowner has to prepay his loan. It was poetic that single financial complexity contributed to the marketplace by the common man was the Gordian knot, giving the best brains on Wall Street a run for their money. Ranieri's instincts that had led him to build an enormous research department had been right. Mortgages were about math. The money was made, therefore, with ever more refined tools of analysis. But the traders did not become correspondingly more refined in their behavior. For each step forward in market technology, they took a step backward in human evolution. As their number grew from 6 to 25, they became louder, ruder, fatter, and less concerned with their relations with the rest of the firm. Their culture was based on food, and as strange as that sounds, it was stranger still to those who watch mortgage traders eat. You don't diet on Christmas Day. You didn't diet in the mortgage department. Every day was a holiday. We made money no matter what we looked like. says a former trader. They began with a round of onion cheeseburgers fetched by a trainee from the Trinity Deli at 8 a.m. I mean, you didn't really want to eat them, recalls trader Gary Kilbert, who joined the trading desk in 1985. You were hungover, you were sipping coffee, but you'd get wind of that smell. Everyone else was eating them, so you grabbed one of the The traders performed astonishing feats of gluttony never before seen at Solomon. Motara made enormous cartons of malted milk balls disappear in 2 gulps. The toner sent trainees to buy $20 worth of candy for him every afternoon. Holt, Jesselson, and Arnold swallowed small pieces whole. Each Friday was Food Frenzy Day, during which all trading ceased and eating commenced. We'd order $400 of Mexican food, says the former trader. You can't buy $400 of Mexican food, but we try. Guacamole on 5-gallon drums, for a start. A customer could walk in and ask us to bid or offer bonds, and you'd have to say, I'm sorry, but we're in the middle of the feeding frenzy. I'll have to call you back. And the fatter they became, the more they seemed to loathe skinny people. No hypocrisy here. We are proud to look precisely as we are. They joke how the thin government traders who ran triathlons on weekends still couldn't make any money during the week, which was not entirely accurate. But it was true that no one made as much money as mortgage bond traders. The market for mortgage trading had turned. At the end of each month, remembers Andy Stone, we'd have department dinners. We'd say we made twice as much as corporates and governments combined. We're the best. And when Mike Motara wasn't made a partner at the end of 1983, and all the other heads of trading desks did, it really united us. We said, we don't work for Salomon Brothers. We work for the mortgage department. Ranieri preserved the culture in spite of its growing numbers with group functions. If it wasn't dinner at the end of each month, it was the trip to Atlantic City, from which government and corporate traders were strictly excluded. The mortgage traders hopped into helicopters, spent a night gambling, and flew back to Salomon Brothers in time to trade the next morning. That's the sort of thing you were meant to do, if you were a trader with iron. Some goofs had genealogies. The suitcase goof had started in 1982, with one trader getting hold of another trader's weekend bag and replacing the clothes with pink lace panties. There were at least 4 goofs and re-goofs of this sort between 1982 and 1985. The goof finally stopped spawning more goofs when John Tatona arrived late one Friday morning with suitcase in hand. He planned a weekend trip to Puerto Rico. He began to lord his good fortune over to the other traders. Hey guys, sorry you can't come along, ha ha ha, etc. Finally, it was too much for Peter Marrow and Greg Aradi. When Tatona's attention drifted, the 2 traders slipped away with his suitcase. They removed the clothes and inserted about 10 pounds of wet paper towels instead. Tatona didn't discover the switcheroo until he emerged from a hotel shower in Puerto Rico that evening. Dripping wet, he made his first call to his prime suspect, Marrow. Marrow confessed. This, said Tatona, was not a funny joke. He called Marrow 7 more times over the weekend to remind him how unfunny it was. He plotted revenge. Marrow awoke to one of Tatona's calls. Early Sunday morning, that apparently began. I don't know how, I don't know when, I don't know where, but one day. Revenge came shortly thereafter, but not upon Marrow. As usual, the blame shifted to the trainee who worked for the culprit. The trainee who worked for Marrow was Gary Kilburg, a member of my training class. Gilbert had lugged his own suitcase to work one day. That evening, he would take the Eastern Shuttle to Washington to meet with, among others, 2 U.S. senators. Suspecting he was Tatona's target, he hid his suitcase in a closet in Henry Kaufman's office. Just as he was about to leave for the airport, his phone rang. It was Marrow. Marrow was sitting about 8 feet away, but when 2 traders wished to speak privately, even at close proximity, they used the phones. Marrow warned Kilburg. Don't tell anyone I warned you, he said, but you better check your suitcase, so making sure no one followed him. Kilburg checked his suitcase. All was in order. Kilburg caught his flight. His trip was uneventful. Yet when he walked onto the trading floor 2 days later, all the traders were laughing, Tatona the most visibly. What's so funny? Asked Kilburg. Did you have a good trip, killer? Said Tatona. Yeah, said Kilburg. What do you mean, yeah? Asked Tatona. Then it occurred to about 6 people at once what had happened. Tatona had, on the day of Kilburg's trip, found a suitcase full of clothes somewhere in the vicinity of the Salmon trading floor. The suitcase had a large gold K stuck on it. K stood for Kilburg, right? Wrong. It hadn't been Kilburg's suitcase. Then whose suit and shirts are these? Asked the trader. pulling some very expensive-looking threads from under a desk. You could see everyone thinking, recalls Kilber, and they weren't thinking small fry. They were thinking big fry. They were thinking Kaufman or Kimmel, or, since they had panicked and were not being rational, Coates. All at once they said, "Oh, what do we do?" Well, when you thought about it, that wasn't a bad question. Whoever didn't have the suits had the soggy toilet paper. Whoever had the toilet paper to wear over the weekend must be steamed. Since the goof had been internal to the mortgage department all along, and there were no Ks in the mortgage department unaccounted for who, of emotional importance, would be the wiser if the suits simply disappeared? No one. So one of the traders bundled the suits in a green glad bag, like a dead body, and dumped them into the construction wreckage across the street from Salomon, in front of the New York Health and Racquet Club. The traders agreed, like Tom Sawyer and Huck Finn, never to tell a soul what had happened. To this day, says Gilbert, they don't know whose suit those were. The department, in short, looked like a fraternity than it did a division of a large corporation. The boss was at least partly responsible for the adolescent nature of his department. He wasn't just one of the boys, he was the ringleader. Mere winning was not as important to Ranieri as winning with style. Skewered by the male spear on Ranieri's trading desk were an orange pair of strippers' panties. It was enjoyable to make more money than the rest of the firm, but it was sheer delight to make more money than the rest of the firm at the same time you spent half your day playing practical jokes on your employees and smoking big fat cigars. A trader recalls Ranieri marching out from his office onto the floor to talk to one of his young traders, Andrew Wiedewald. He had this big smile on his face. He was standing real close to Andy and asking him how a deal was going. Andy was saying how he hoped to sell some bonds in Japan and London, and Louis just stood there nodding with this weird smile. Andy said something else, and all Louis did was stand there and smile. Then Andy felt the joke. Louis was holding a big lighter right under Andy's balls. His pants were about to catch fire. Andy hit the roof. Another Andy, Andy Stone, recalls having a bottle of Bailey's Irish cream poured into his jacket pockets by Ranieri. When he complained that it was his favorite suit, Ranieri whipped out 4 soiled $100 bills and said, "Don't complain, buy a new one." Ranieri was impulsive in a way that business school case studies seldom account for when they analyze managerial decision-making. In her first day in the Salomon Mortgage Finance Department, as she was being given a tour of the firm, Maria Sanchez recalls meeting Ranieri in the hallway. "I had no idea who he was," she says. "He came waddling down the hall like a penguin, waving one of his long swords. He kept a collection in his office. He walked up to my tour guide and pointed to me with the sword and asked loudly, 'Who's this?' We were introduced, and he asked, 'You Italian?' I said no, I was Cuban. I was wearing a blouse with a long string bow tie. Louis took out a pair of scissors and with this big smile on his face cut off my tie. He said he didn't like ties on women. He pulled a $100 bill from his wallet and told me to buy a new shirt. I thought, Jesus, what have I gotten myself into?" Eventually, Ranieri was pressed to reform by John Goodfriend. Though Goodfriend wasn't above having a little fun himself, he was, after all, running a large corporation. His vice chairman was beginning to look more like his chairman of vice. If he was going to promote Louis would at least have to look the part. I remember one day Louis came over and threw his American Express card at Liz and told her to go to Brooke Brothers and buy him a wardrobe because John said he had to change his image, says Andy Stone. Goodfriend's concern went past the clothes to the man. Goodfriend was watching Louis wait for him, says another trader. I remember once when we ordered pizza. Goodfriend came over. Louis wouldn't eat any until Goodfriend went away. Everyone knew which one was Louis' pizza. He had this look on his face. Touch that pizza and you're dead. Ranieri's memory of his metamorphosis is slightly different. He recalls one day being euchred by his wife, Peg, and Liz Abrams into a trip to Barney's. I agreed to buy one new suit, he says. We walked through, and the guy helping us asked me what I think of these suits. Each time I said I liked one, this guy pulls it off the rack. Lizzie has told the guy I'm going to buy every one I like, but she hasn't told me. By the time I'm through, I've picked out 9 suits. Now I have to do what I hate most. Stand around and fit all these things. While I'm doing this, Lizzie takes my credit card and says she's going to pay. But she comes back with 3 slips. What's this? I ask her. She bought 9 suits, 15 ties, and 24 shirts with monograms and a bunch of these little things here. I'd been euchred. Not entirely. He he found ways to foil his appearance-conscious advisors. Most of his new suits were three pieces, which by some miracle of justice went out of fashion immediately after he bought them. Anyway, Ranieri never really wore his new clothes. One trader remembers he'd come in every morning with his vest slung over one shoulder and his tie slung over the other. And there was no chance whatsoever Ranieri would permit his new look to interfere with the down-to-earth image he projected to his clients. The new clothes became a clever foil for his old self. Jeff Kronthal recalls being out to dinner with Ranieri and a client of Salomon Brothers when Ranieri spilled soup on his new thin tie and shirt. He was off and cursing. He said that if they let him wear his wide ties, it would have only ruined the tie and not the shirt. Before a trip to see another client, the state of Alaska, it was pointed out to Ranieri, who wore only a suit, that since it was March, he might need an overcoat in Alaska. He gave his American Express card to Liz Abrams, who brought him an $800 Chesterfield at Brooks Brothers. Off went Ranieri to Alaska, resplendent not only in a relatively new suit, but in a brand new overcoat. However, between the 41st floor and Alaska, he lost his shoes. He replaced them, apparently duty-free. He met with the client in his $800 overcoat and a $19 pair of bright orange imitation stack boots with heels 6 inches high. It was a great act, perhaps the best on Wall Street. You couldn't put your finger on why, when two seemingly equal people sat in the same trading position. One made $20 million and the other lost $20 million. The John Merriweather, Liar's poker champion, was the Salmon trading manager who came nearest to the perfection in spotting future trading talent. Yet even he erred. He once hired a man who panicked whenever he lost money. One day the man, finding himself in a hole, broke. "They're out to get me. They're out to get me." He shouted over and over until someone hustled him off the trading floor. You couldn't always put your finger on losers, but you knew talent when you saw it. Howie Rubin had it. Of all the traders, Rubin displayed raw trading instinct. Louis Ranieri calls Rubin the most innately talented young trader I have ever seen. The other traders say he was the trader most like Louis Ranieri. One trader remembers that Louis would say he thought the market was going up and buy 100 million bonds. The market would start to go down, so Louis would buy 2 billion more bonds, and of course the market would then go up. After he had driven the market up, Louis would turn to me and say, "See, I told you it was going to go up." Howie had a little of that in him too. Rubin joined Salomon Brothers in the fall of 1982 from the Harvard Business School. What interested everyone most about Rubin, from Ranieri on down, were the years he had spent counting cards at a blackjack table in Las Vegas. A Harvard graduate who counted cards was a rarity, a synthesis of the old Salomon and the new. In 1977, Rubin was a chemical engineer fresh out of Lafayette College, working for an excellent refinery in Linden, New Jersey. He made $17,500 a year, which at the time he thought was good money. "After 6 months, I was bored," he says. "After a year and a half, I was really bored." What do you do if you are a bored chemical engineer in Linden, New Jersey? You watch TV and drink beer. Flipping channels one night, Rubin and a college friend ran across a 60 minutes piece about a man who made his living counting cards in blackjack. If he can do it, how tough can it be?" said Rubin. He read 3 books on the subject and moved to Las Vegas. In 2 years in Las Vegas, he parlayed $3,000 into $80,000. The tough part wasn't breaking the system. The tough part was not getting tossed out of casinos, he says. By the time he left, every casino in town carried his photograph. He would wear disguises to sneak past the security guards. When eventually he became bored with counting cards, he enrolled in Harvard. He learned that there was such a job as trading bonds from his more worldly classmates. He knew immediately, he says, that it was his calling. Rubin found a prepayment game he played with discount mortgage securities similar to counting cards. Blackjack is the only non-independent outcome game in the casino. What happens in the past affects what will happen in the future. There are actually times when you have a statistical advantage, and that is when you make the big bets, he says. At Salomon, he had the advantage of superior information about the past behavior of homeowners, and only when he had this edge did he make the bets. What's more, he says, the trading floor at Salomon Brothers felt like a Las Vegas casino. You made your bets, handled risk, in the midst of 1,000 distractions. To feign indifference before the blackjack dealer in the casino while he memorized every card that was dealt, Reuben engaged a neighbor in conversation and drank gin and tonics. At Salmon Brothers, he traded bonds while being hollered at by 6 salesmen, eating a morning cheeseburger and watching Ranieri hold a big lighter under the of a fellow trader. In his first year out of the training program, 1983, Reuben made $25 million. The several $100 million question that has never been asked by the management of Salmon Brothers was first raised by Howie Reuben, who really made that money, Howie Reuben or Salmon Brothers. In Reuben's view, it was Howie Reuben. In John Gutfrin's view, it was Salmon Brothers. Gutfrin felt the firm created the opportunity for Reuben and therefore deserved the bulk of the rewards. Gutfrin's view, of course, prevailed. The first 2 years out of the training program, Howie Reuben, like all trainees, were placed in a compensation bracket. In his first year, he was paid $90,000, the most permitted a first-year trader. In 1984, his second year, Reuben made $30 million trading. He was then paid $175,000, the most permitted a second-year trader. He recalls, the rule of thumb at Harvard had been that if you are really good, you make $100,000 3 years out. The rule of thumb no longer mattered. In the beginning of 1985, he quit Salmon Brothers and moved to Merrill Lynch for a 3-year guarantee, a minimum of $1 million a year, plus a percentage of his trading profits. Who could blame him? Certainly not his fellow traders. They understood. You didn't ask a trader to squeeze every last penny out of a market for Salmon Brothers. Train him to exploit the weakness in others and expect him to roll over and purr at bonus time. At the end of each year, the people on the Salmon Brothers trading floor dropped whatever they were doing for a period of several weeks and traded their careers. What are they paying me? What are they saying to me about my prospects? How much money can I get from another firm? There was even a game, much like Liar's Poker, played by traders against the firm. Wolf Needleman calls it how to be paid $350,000 a year and pretend to be upset about it. The point of the exercise was to inform the firm that maybe, just maybe, $350,000 would suffice this year. But next year, if it didn't pay you properly, you'd be doing a runner. You might be bluffing, then again you might not. John Gutfrin, although himself a trader by training, did not grasp the contradictions inherent in his compensation system. The unprecedented profits in the mortgage market strained the Salmon Brothers spoils system as it had never been strained before. Gutfrin's attitude took their final shape in the days when the firm was a partnership. Loyalty could then be pretty much taken for granted. In a partnership, a trader was required to keep a substantial portion of his wealth in the firm. If he left the firm, he lost a fortune. That system ended when Gutfrin sold the firm to Phillips Brothers, the commodities trader, in 1981. Now, a peach-fussed youth would emerge from the firm's training program, be sent to chase a new opportunity in the mortgage market, reap tens of millions of dollars in profits, and then demanded a cut of what he had produced. Gutfrin had no intention of paying anyone a cut. He entertained a notion that X was enough, and his notion was rooted in an era when paying $1 million to a second-year trader was unthinkable. And anyway, Salmon Brothers, not Howie Reuben, had made that $25 million trading. Gutfrin openly criticized what he considered the overweening greed of younger generation. In 1985, he told a reporter from Business Week as he waved his hand magisterially over his employees on the trading floor, "I don't understand what goes on inside these pointy little heads." His hypocrisy was noted and resented by the mortgage traders. It was easy for Gutfrin to say money didn't matter. He paid himself more than any chief executive on Wall Street, and he had already made his fortune by taking $40 million out of the firm to Phillips Brothers. His attitude, as well as those of other old partners, toward the firm changed once he had cashed in his chips. He and others ceased to view Salmon Brothers as an instrument of wealth creation and began to treat it as an instrument of power and glory, a vast playground in which they could be the bullies. Gutfrin especially seemed to revel in the playground's growth. He loved to point out that Salomon was the world's most powerful investment bank, with $3 billion in capital. He took obvious pleasure from the concept of being a global investment bank. Offices opened and expanded in London, Tokyo, Frankfurt, and Zurich. The firm, which had employed 2,000 people in 1982, had 6,000 people by 1987. All this can be attributed, one supposes, to a healthy desire to remain competitive. However, many of the mortgage traders argue that growth for growth's sake reflected glory upon John Goodfriend. Often, he would point out that Salomon Brothers carried $80 billion of securities on its books overnight, every night. He would follow this observation by saying that, in asset size, Salomon Brothers was the largest commercial bank in the world and one of the 40 largest countries in the world. As one mortgage trader said in response, "Come on, John, you're not talking the Netherlands. You're talking about a bunch of Jews who are leveraged." The concept that he presided over no more than Jews with leverage was as alien to Goodfriend as the Netherlands. Salomon Brothers, where he was boss, was bigger than that. By the commutative property of executive grandeur, John Goodfriend was bigger than that. Howie Rubin, on the other hand, didn't really figure, except as a cog. He could be replaced by another trainee. The traders thought of Goodfriend's system as a bad trade. The upside was to stay at Salomon, and if the firm continued to prosper, the trader could hope to be repaid for past performance. The downside was that the firm ceased to be profitable and the trader's best years were wasted. Therefore, Howie Rubin took the $3 million contract from Merrill Lynch in March 1985 and became a legend in his own time. Word of Rubin's coup filtered back into our training program, and he was spoken of by people who had never met him. "Did you hear what Howie Rubin got at Merrill?" people asked, rhetorically, of course, since everyone knew. The Howie Rubin legend drew into mortgage trading people who planned to leave just as soon as they got their $3 million contracts elsewhere. A whole new attitude toward working at Salomon Brothers were born, hit and run. And that is how Salomon Brothers, and the mortgage trading desk in particular, became a nursery for the rest of Wall Street. Corporate, government, and mortgage traders streamed out of the place in ever-increasing numbers, to the point where one day a senior corporate bond salesman said he was thinking about moving to Merrill Lynch because he knew more people there. The mortgage department was hit the hardest by the phenomenon. From the point of view of other firms, Salomon mortgage traders were cheap at any price. They provided entry to an enormous market from which a firm was otherwise excluded. They were often paid, therefore, far more than they expected. The Reductio ad absurdum of the phenomenon was Ron DiPasquale. In 1984, DiPasquale was, as one trader says, a third-string mortgage trader. He had moved out onto the trading desk from the back office and hadn't much experience trading when Merrill Lynch called and offered him $1 million a year guaranteed over 2 years. He was to be its new head of mortgage trading. While it is true that DiPasquale later distinguished himself as a trader, at the time he knew next to nothing. Merrill Lynch discovered its mistake about a week too late. DiPasquale had his contract in hand. He was given a seat in the back office of Merrill Lynch until his contract expired, whereupon he returned to a standing ovation at Salomon. Hail the conquering hero. Precious few traders were invited to return to Salomon after they had jumped ship, but DiPasquale was made an exception. His move to his superiors was a practical joke played on Merrill Lynch. Howie Rubin wasn't a joke. The strangest thing about his departure was his reluctance. He claims he nearly turned down the Merrill Lynch offer, but once he had decided to accept, he didn't dare turn up at Salomon Brothers to reveal his plans, for he knew how easily he could be persuaded to stay. He wanted to stay. He had hoped to have a career with Salomon Brothers. "I couldn't have been happier there," he says. What he loved most about the place, he says, is all you had to do was trade. So instead of making an appearance, he telephoned Motara, who suggested they meet for lunch at the South Street Seaport. Even mortgage traders couldn't choose their moments of self-revelation. Rubin remembers crying as he spoke with Motara and Kronthal while they sat on the curb outside the seaport. It was like leaving a family, he says. Far from trying to persuade Rubin to remain at Salomon, his superiors made it clear they understood. Howie Rubin, quite simply, had been bought. From that fate, no trader was immune. It could just as easily have happened to Motara or Kronthal. Motara now says, "Look, I tried to be a good corporate citizen while I was there, but I think the people who participated in the development of the mortgage market were victims or at least severely penalized by the Salomon Brothers compensation system. Their pay was way out of line with their production. It was an odd tragedy. All parties suffered, yet it was difficult to generate a whole lot of pity for any of them." The mortgage department had made a fortune in 1984, while the firm as a whole had not done well. The traders, therefore, were not paid according to what they produced. Considering the feelings about the rest of the firm, The idea of having to nurse others in bad years did not sit well. After Ruben's departure, Tom Kendall, Steve Baum, the top salesman Rick Borden took the $1 million offered each of them by the Farmers Savings Bank in Davis, California. Steve Roth and a new mortgage trader named Andy Astrachan took the $1 million and probably much more offered by Mike Milken at Drexel Burnham. All of a sudden, 3 of the 4 most profitable mortgage traders were gone. The fourth was Andy Stone, who in 1984 had made $70 million trading 15-year mortgages called because of their short maturities, midgets, gnomes, and dwarves. In the middle of 1985, Stone received a call from Merrill Lynch, which offered to double his pay. Stone declined. I thought I would be at Salomon until I was 50 years old, he says. Like Rubin, he didn't want to leave the mortgage department family. Then Merrill asked me what it would take. They said everybody has his price, he says, assuming that Merrill would balk. Stone said his price was 4 times his 1984 paycheck. Instead, they said okay, and so it was done. Stone had accepted a guarantee sweeter than Rubin's to join his buddy Howie as co-head of mortgage trading at Merrill Lynch. At that point, Salomon Brothers panicked. Ranieri and Mortara asked Stone to reconsider his move over the weekend, since they were like family. He did. What happened next resembles the fate of any profitable employee who dallies before leaving Salomon Brothers for a competitor. The employee is hauled before a series of bigwigs. The bigwigs attempt to persuade him, using a variety of arguments, that he is making the mistake of his life. The first line of argument is usually that without Salomon, one would end one's days in misery. As one trader put it, you were made to think anyone who worked at another firm must be an idiot or an so if you went to work for another firm, you must be an idiot or an The members of the executive committee must have realized that because the traders who had left were smart, and they were Stone's pals, so he would resist the notion that they were either idiots or As the mortgage trader says, a friend leaves from Merrill Lynch and you say, wait a minute, he's not an idiot or an But then another friend leaves, then it dawns on you. On Monday morning, Stone saw the same 3 men, in the same order as had appeared before our training class: Jim Massey, Dale Harowitz, and John Goodfriend. Massey came first. Massey, as he had made clear to our training program, operated on a level of fear and intimidation. Massey laid a guilt trip on me, says Stone. He said, you owe us. We made you. You can't leave. Stone already distrusted anyone outside the mortgage department. He quickly put Massey behind him. He pointed to the $70 million he had made for the firm and said, I think we are at least even. Massey passed Stone to Harowitz. Dale Harowitz was the member of the executive committee who played the role of human being. Uncle Dale. He started out, says Stone, by saying, I've watched you closely since you've joined us. I've been following your career. You may not have realized it, but I've taken a special interest in your development. It was the usual line, but it took an unusual and pitiful turn when Harowitz said, I had a hand in the move you made from junk bonds to corporates and corporates to mortgages. Wait a second. Stone had never been in junk bonds or corporates. Stone realized that Harowitz was describing Andy Astrachan, not him. Stone had been in mortgage trading from the start. He must have asked his secretary for the file on Andy, and she got the wrong one. I was so embarrassed for him, I almost didn't tell him. Almost. Harowitz passed Stone to Goodfriend. Goodfriend and I were not exactly good buddies, says Stone. I walked into his office, and he says, first thing, I guess you're here to discuss puny problems. You probably want to talk about you and how much you are paid, instead of big questions like the direction of the firm. Exactly what this approach was designed to achieve is not clear. Stone stiffened. He asked Goodfriend if he would sell the mortgage department for $10 million, to which Goodfriend responded, of course not. Stone said, you might as well, because we're all going to quit. Every one of us will leave for a total increase of $10 million. Goodfriend said, you're as difficult as your reputation. But before Stone could leave the office, Goodfriend asked him how much money he would require to stay. Stone said, I'll stay here for less money, but I won't let you rape me. Goodfriend agreed to pay Stone 80% of what Merrill had offered. It was the first and last time that management capitulated in the face of a departing mortgage trader. When news spread at the end of 1985 that Andy Stone had been paid $900,000, unheard of for a 4th-year Salomon trader, the corporate and government departments expressed extreme displeasure. The other mortgage trader had to be paid hundreds of thousands of dollars more than they otherwise would to bring them into line with Stone, but corporates and governments had been excluded from the bonanza. Salmon etiquette had been violated. Such things were just not done. From that point on, says Stone, I was never treated well at the firm. Whenever I lost money on a trade, they'd say we should have let him go. The firm decided quickly enough that it was a mistake to have met Stone's demands. A single large paycheck had thrown into doubt not only the compensation system, but also the long-standing pecking order within Salmon Brothers. Money was the absolute measure of one's value to the firm. Paying a mortgage trader much more than a treasury trader made the treasury trader feel unwanted. It wasn't going to happen again. To stanch the flow of his young mortgage trading talent out the door, Mike Matara was forced to resort to diplomacy, which never worked as well as cash, especially with traders. He arranged 2 dinners at the end of 1985 between his traders and John Goodfriend. The first was held at Goodfriend's favorite Manhattan restaurant, the Perigord, where, according to one gourmand, the man in the kitchen has a way with birds. Among those present were Matara, Cronthal, Stone, and trader Nathan Kornfeld. Goodfriend was impressive, totally dominant, says one of the men present. I left thinking how pleased I was that he ran the firm. Otherwise, the meal was a disaster. It is doubtful anyone tasted the food. Goodfriend took control, in a way only Goodfriend can. He embarrassed Matara, who was by that time a managing director, by referring to how much money Matara had made on his Salmon stock when the firm went public. No doubt Goodfriend had dug those data out of a file especially for the dinner. Mike turned bright red, says one of the traders present. Then Goodfriend raised the issue of compensation. Stone, as usual, spoke his mind. He told Goodfriend that since mortgages were the most profitable area of the firm, the traders should be paid more than the rest of the firm. That's when Goodfriend blew up, recalls one of the traders. He went on about how it was an honor to work at Salmon Brothers and how the firm, not the people, created the wealth. Anyway, Goodfriend said the mortgage department overrated its importance. It wasn't even as profitable as the government department. The traders knew this was a bold-faced lie, but no one contradicted him. No one wanted to see John any angrier, says Stone. The evening ended on a strained note. The second dinner between Goodfriend and the traders was cancelled. It was clear to everyone that it would only aggravate the festering wound. Young traders continued to depart Salmon Brothers, and at the end of 1986, Andy Stone joined Prudential Beige as head of mortgage trading. 呢一節讀完啦，內文就帶我哋讀者經歷咗呢個 Salmon Brothers 嘅興衰啦，可以咁講啦。去到最後係直情係衰落，而衰落嘅原因就係因為跳槽啦，俾啲其他嘅大行拉走咗最賺到錢嘅 trader 啦。而呢啲 trader 咧，即係全部都係做 mortgage bond 嘅，當然係重金禮聘啦。拉走人之後咧 ，Salmon Brothers 反擊嘅方法咧，就係呢一刻咧係冇嘅。嗰個士氣亦都係蕩然無存，包括 John Goodfriend 在內啦，佢哋做嘅就只係負面情緒啦，亦都冇令到仍然留喺度做嘅 trader 開心啦，重金留喺度嘅人亦都唔開心啦，所以其實係由裡面崩壞啦，即係成也沙羅敗也沙羅，自己整死自己啦，可以咁講。當中嘅原因就人工唔夠高啦，重金俾人挖走啦。好，咁我哋睇下呢一節有啲咩字同大家分享，揀多啲 informal 啲嘅美國嘅字啦嚇。Spiel S-P-I-E-L informal 嘅名詞 ，an elaborate or glib speech or story, typically one used by a salesperson， 即係一啲宣傳要賣嘢啊，要推銷長篇大論嘅嘢啦，滔滔不絕咁嘅意思啦。Spiel Cushy。我諗今時今日都比較少講 Cushy 形容詞嚟嘅 informal 嘅都係美國嘅用詞，意思即係 undemanding、easy or secure 嚟形容美國其中之一種啦。作者將嗰啲 mortgage bond 分為兩種啦 ，upmarket 啲嘅房產啦，就稱佢之為 Cushy 啦，呢啲叫 Cushy bond， 即係舒服啲嘅，用家又負擔得起嘅，隨時可以 repay 到嘅，呢叫 Cushy bond 啦。中文意思即係輕鬆啦，輕鬆啲啦，安逸啲啦嚇。我諗同 cushion 呢個字有啲關係啩。第三個就係拉丁文嚟嘅 ，Reductio ad absurdum。Reductio ad absurdum 唔係咒語嚟嘅， 呢個係一個名詞 philosophy， 佢嘅意思係 a method of proving the falsity of a premise by showing that its logical consequence is absurd or contradictory。中文我哋翻譯做歸謬法，歸就係歸家個歸啦，謬就係謬誤個謬啦，歸謬法。你要用一啲邏輯去反證一樣嘢，用一個邏輯性嘅思考，通常係去反證一啲事情嘅，就唔係去認同一啲事情。Reductio ad absurdum，Reductio ad absurdum， 相信大家比較少見。好，今日就讀到呢度，我哋下一次繼續，拜拜。